Hello, and welcome to a new version of Advanced Projections News versus Noise feature. This is dated July 1st, 2022. So what we're going to do is a quick review of what's in the financial noise and what is actually happening in the news and the activities in the economy and the markets. So the financial noise, well, when you heard it in the popular media, it was already part of the noise back in June. Inflation concerns are still growing. Well, great. Finally, everyone is taking it seriously, especially the Federal Reserve. And they've been telling us about this since last November. Unemployment is down still at near record lows at 3.6%, which is much lower than previously expected. But the real news is that the Fed now does not have to pay any attention to unemployment for a long while. They are going to resolutely focus on inflation. We have high gas and high energy prices. Oh my God. Well, the news is that the latest Fed rate hike may have already cracked that. When the Fed rate hike was announced on June 15th, oil fell 10% within days, and it has stayed down at that 10% down level or even less. So it looks like that is being digested by the markets, and we expect to see the same thing happen when the next rate hike is announced at the end of July. Stock markets entered bear territory from January through mid-June. Well, great. All right. That's what we've been expecting. What's likely to come next and why? Many financial advisors out there in the popular press, on the talking heads on TV, or private financial advisors are still sticking to the stay the course mantra. The news is it's still a bad idea, and we'll show you why. So in the real news, well, first of all, the new equities markets declines are going to go much deeper and be very prolonged. So the misconception of staying the course, just hanging in there, is going to cost you a lot of lost money and opportunity. Why did this happen? Why did the markets go so high? The economic environment was awash in cheap cash, much of which was, quote, invested in grossly overvalued asset speculations. Now, here's what you should be paying attention to. Latest employment expansions recorded up through mid-June. Unemployment still remains well under 4% at 3.6%. The Fed loves this. This is one of their mandates is fulfilled, full employment. Okay, so effects of the pandemic upon the domestic economy are now basically in the rearview mirror, aside from residual supply chain issues, which we've recently read may be clearing up somewhat. We'll find out over the next couple of months. Exploding energy prices, which have been contributing to inflation, may just have cracked with the Fed's 75 basis point rate hike, and expectations of another one of that size being likely in late July. We should expect this similar action in energy prices if it continues, and it will reflect concerns about an upcoming recession and what happens in every recession, retreating demand for oil. So as of this publication date, oil is down about 15% from its recent price peak. Oil and petroleum products are very sensitive to small changes in supply versus demand. A few percent undersupply causes prices to spike, and a few percent oversupply causes prices to collapse. Something else we pointed out last time, we're reemphasizing it here: low unemployment precedes recessions. This chart, which is only reflecting data through the end of last year, chart told us that, okay, in the last 3 recessions, unemployment basically bottomed out. Well, we're down here again already at 3.6% unemployment. And the labor force participation rate is right back up here again. Okay. And our subscribers will see updated charts that reflect this information. Now, the fast and massive federal intervention from the Treasury and Federal Reserve Bank short-circuited the worst of the COVID recession consequences, and that left the economy awash in cheap cash with nowhere to go except for equities and real estate and some less tangible items such as cryptocurrencies and non-fungible tokens. Now, changing that landscape, the Fed has wholeheartedly tackled inflation via rate hikes and declining money supply, causing a deep correction beginning in January of this year. We're now 6 months into that correction. Here's the 2 things you need to be paying attention to. Federal Reserve Chairman testified before Congress in mid-June, and he upheld the reasons for proceeding with their clearly scripted plan, while emphasizing, their, as much as they can, their emotional sensitivity to the economic pains from rising rates. But they are going to continue unwinding their balance sheet and raise interest rates during 2022 and 2023. Their turning point was when they reached full employment at or below 4%. And the last low pre-pandemic value was 3.5%, and we're now at 3.6%. We'll get a new figure out here in a few weeks for June and the entire second quarter. Now, the Federal Open Market Committee meetings from November, December, and January contain the changes in Fed rhetoric and planning, and they're issuing firm guidance about next steps to manage the health of the economy, just as we predicted before these meetings. In their March, May, and June meetings, they confirmed this stance and included the first 3 of several rate increases planned for 2022. As well, the money supply growth is already being curtailed as the Fed unwinds its balance sheet, which tends to pull liquidity out of the markets. The May M2 money supply actually contracted by almost 1.2%. So they are already well into the process of unwinding their balance sheet. We're looking for them to take 10% approximately out of the money supply. AP believes the Fed will monitor effects of foreign adventurism by Russia, but they will continue to proceed firmly and aggressively to rein in inflation over the next 18 months. So the second major issue is the equity market super bubble collapse had already begun back in the first quarter. It started in early January, which combined with inflation may push us into recession relatively soon in the next 6 to 18 months. The equity collapse is now preceding the onset of the next recession, just as we predicted 6 months ago. Now, these are a couple of charts, very simple charts showing the demise of the super bubble. This left chart is what's known as the Shiller PE ratio, which is the average PE of the S&P 500 averaged over 10 years. So what this does is tends to filter out any short-term year-to-year noise and just looks at, what's going on in equities over the course of any preceding decade. So we see 3 peaks at a PE ratio of 30 or above. And this one, which was really, if you look at a continuation, COVID caused this little collapse here, but the federal response just drove things right back up to where they would have gone. So we're looking at something that would have continued like this without COVID. So here's the Great Depression. This is the dot-com bubble collapse. This is the current super bubble collapse of 2022. So it has begun. We've moved down rapidly off that peak, and the bottom is going to be way down below here sometime in the next 12 to 24 months. We don't know exactly how rapidly that will occur, but this chart reflects how fast this bubble collapsed, and we're tracking the current one right along with it. So the red track is what happened to the dot-com bubble and its crash, which was down nearly 50%. Okay. And this is the super bubble with, again, the peaks of the two crashes aligned, and we're only 6 months into this decline. This decline took, what are we saying here? Oh, about 2.5 years. Okay. 2 years down to here, and it stayed more or less flat for another half a year. So that's how long it took the dot-com crash to occur. We're 6 months down the road. Now the new data point is right here, right on track that we've extrapolated in the light blue. June's close is at 3,800. So this is where we're at right now on the super bubble. And it's, we can't predict volatility along the way, but we sure can look at how low we expect it to go. And this is a greater than 50% loss within about 2 years. So we've added a little illustration to our concluding remarks. John Templeton, greatest investor of the 20th century. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Well, this one has started to die. The euphoria ended basically in January. And you look at the growth of that bubble taking place here ahead of January. Astute investors would have been exiting here. We're now down to the worry and nervousness phase right now at the end of the second quarter. Pretty soon you're going to start seeing, again, reflected in the popular media, news about investor nervousness and investor alarm, and people start wringing their hands, doom and gloom, and there'll be a capitulation, massive selling going on, which will finally flush out the last of the weak holders of shares and the last of the nervous holders. We don't advise, showing your strength by hanging on through this whole thing, because this curve sort of reflects what stock prices are going to do as well. Getting out here or getting out here saves you all of this, and we'll let you know when the bottom is in. Not to the precise day, not necessarily to the precise week, but within a couple of months. And it takes many months for bottoms to be put in and confidence and buying to be reestablished before new highs come along. So as we said, the euphoria is over. The realities of the super bubble created by the massive federal economic COVID interventions will now correct over many months, perhaps longer. Rising rates, energy prices, foreign adventurism will create the necessary fear and uncertainty that pops the bubble. In fact, it has already begun and must inevitably cycle through the full range of bear market emotions, finally ending in capitulation at the bottom. Thanks for listening. Give this video a thumbs up if you would, please. Subscribe to our AP Newsroom YouTube channel. You have a chance to see all of this in our detailed monthly reports, the entire history from the last 9 years of AP's existence. You can see it with a full membership, which you can have on a trial basis via a link in the description below. You can join our economy monitoring group on Facebook, And of course, we welcome your comments, your thoughts, and questions either here in the channel or by writing to us at advancedprojections.com. Thanks for listening, and have a really interesting July.